Happy New Year. Thank you for joining us for our 2014 Outlook. The title, Removing the Training Wheels, is a metaphor for the Federal Reserve scaling back the unprecedented level of stimulus they've been providing to the marketplace here. And the real measure for that is their balance sheet. If you look at the balance sheet of the Fed, you can see the explosion here in 2008 through QE1, quantitative easing 1, with the purchase of distressed securities, then again in QE2 in 2010. And the final, most recent stage here, QE3, which as of December 10th, the Fed indicated they were going to start tapering or reducing the purchases of securities from $85 billion on a monthly basis to $75 billion. The concern is, as the punch bowl is being pulled away, can the economy continue to move ahead with that? And we'd point out, first of all, here the green is our expectation for what the Fed balance sheet will look like as the Fed continues to taper. It means that the balance sheet's going to continue to expand. Tapering isn't tightening, as the headline indicates. Rather, the balance sheet is just growing at a diminishing rate. Now, once they're finishing tapering and there's no more quantitative easing through purchase of securities in the marketplace, the balance sheet will start to shrink through maturities and paydowns of the securities. But you can see, bottom line is there's going to be still a significant amount of stimulus here in the marketplace and in the economy, not only this year, but into 2015. So the punch bowl is far from being yanked away very quickly here. As far as what the Fed's looking at as a guidepost for whether they will accelerate or slow down their rate of tapering, what the Fed's looking at is the unemployment rate. That's been the measure that they've indicated as their most key benchmark here. And we got a reading yesterday or this morning that the unemployment rate has fallen to 6.7% now. The Fed has indicated historically some months back that 7% would be the level that unemployment would have to fall before they would consider tightening. They subsequently said unemployment would have to fall well past 6.5%, which we could reach here in the months ahead. The bottom line is we believe that over the course of the next year or so, this is going to be very data dependent. The Fed's going to be not only concerned about the absolute level of unemployment, but the quality of that. In other words, the bottom bullet here that indicates labor participation has fallen to 62.8%, which is a 35-year low. Participation rate is a measure of what percent of the able working force is either employed or looking for work. And the fact is that a lot of this improvement here along the way for the unemployment rate has not been a function of new people going to work, but rather people exiting the job market, so the denominator shrinks. So the Fed is certainly keeping a watchful eye on the participation rate as well as the nominal unemployment rate. The fact is things continue to get better, but slowly. As far as our attitude towards inflation, Fed height and inflation, we believe, has bottomed. And with all due respect to the Fed, the fact is, in the last few years, the Fed has been much more concerned about deflation than inflation. And our belief is that inflation, much like Federal Reserve chair height bottoming, so has inflation. As such, even though it still doesn't look like we're building a base here or bottoming on inflation, either core or total, our expectation is that it is going to start trending modestly higher. We have confidence in Fed Chair Yellen, her belief and her attitude that 2.5% will be the upper ceiling that's tolerable for inflation, will not be a problem not only this year but next. So is the best over for inflation? Yes. Is it going to be problematic in the near term? No. What about interest rates? The yield curve from overnight rates on out to 30-year maturities at the beginning of the year looked like this. And as the year progressed, as we got into the summer, the Fed started what we call taper talk. In other words, jawboning rates up, if you will, indicating that they were considering scaling back the purchase of securities. You can see how the bond market responded. The yield curve shifted up here almost 100 basis points, almost 1% across the curve, with just the prospect of the Fed starting to taper. The Fed did taper here on December 10th, and you can see what happened between December 10th and the end of the year. Almost nothing, a very slight move here in the yield curve up. In other words, the bond market had already discounted the tapering long before it actually happened. As we roll forward to the end of 2014, our belief is the yield curve will continue to shift up, though not evenly. In other words, the most of the pain will be in what we call the belly of the curve. In other words, maturities between 5 and, say, 15 years here, whereas the short rates, we think the Fed's zero interest rate policy in the short term will by and large hold, and because inflation expectations will be fairly modest, the long end of the curve won't rise as much. But bottom line is we think if you look at the 10-year as a proxy for rates, we think rates will go from somewhere around 3% on the 10-year to 3.5%. If we're wrong, it will be the error of the estimates probably slightly higher. So Rates continue to be up. As such, our fixed income portfolio durations are short relative to the benchmarks in anticipation of slightly higher rates throughout the year. As for equities, it's been a great 2-year run. The S&P is up over 50% over 2 years, and that's happened 20 times in the history of the market. The question is, with that great run we've had, what can we expect this year? Looking back at history, the 20 times, you can see we've plotted the return for that third year. In other words, just scanning this with your eyes, you can see what the data will tell you that, number one, about 2/3 of the time the market's been up that third year, and about a third of the time the market has fallen. The average return over this period of 20 observations is 12%, and the average return for the market over all of this period, over all years, is 12%. So, not to be flip, but what do we expect for the market? Well, average. In other words, this data really tells us that looking in the rearview mirror tells us nothing about what's going to happen next year. And to formulate an expectation for the year ahead, you have to look out the front windshield. And for that, we look at earnings and expectations for what multiple investors will assign to $1 of earnings. And here we look at earnings on the S&P. The green shows actual, and the shaded green is expectations for this year. Consensus calls for earnings to grow about 7% on the S&P, up to $115. If we get a little bit of multiple expansion, say to 18 times, that would call for a base case return for the market of 12%, or 10 to 12 to be approximate, as our base case outlook here. If we're wrong, the error to the estimate's probably to the upside. That remains to be seen. But if that does happen, if we do get a return that is trending up above this base case, that will start getting us our attention in terms of valuation for equities, and we'll look to reduce our commitment there at that point on a valuation basis, we would guess. In terms of allocating capital around the world, because we think the commodity supercycle is really over, largely led by the slowdown in China and the oil and gas boom here in the United States, we're underweight the commodity-sensitive countries, Canada, Brazil, and Australia in particular. China, Japan, and the UK were neutral as far as the largest economies around the globe. Japan's been very successful in stimulating their stock market through a quantitative easing that's 3 times that of the U.S. as a percent of its GDP, sending their stock market up about 50% last year. However, because of structural issues, demographic issues, leverage in that country, and debt, we're hard-pressed to go any more than neutral to Japan at this point in time. Our overweights globally are the United States, Mexico, a European Union that's coming out of recession, and in the frontier market investing, some parts of the Middle East are areas where we're overweight. In terms of allocation between the major asset classes, we remain very underweight fixed income, overweight equities across the board, with small cap being the biggest percentage overweight, large cap and international also being overweight. Real estate, REITs being at the low end of this, that being an interest-sensitive sector. It's one that higher rates present a real headwind, and as such, we're quite underweight there. Similarly, because of the concern over higher interest rates, sectors within the domestic market cap here, large cap as well as small cap, we're underweight the interest-sensitive sectors of telecom and utilities. In terms of a wrap-up, as we said, we expect rates to trend modestly higher. The wealth effect of higher real estate values as well as higher stock prices is going to provide a greater stimulus on the part of consumer spending, which is still 70% of the economy. We think the improving backdrop should benefit flows of funds out of bonds and into stocks, perhaps signaling we're getting closer to the end of the bull market run in equities. We believe the average return for equities is still a reasonable assumption. However, flat to negative return for bonds are what we expect. As far as things that could go wrong, if our expectation for modestly higher interest rates becomes too modest and rates actually rise more rapidly and therefore impair the housing market as well as the bond and stock markets. And also if Europe lapses back into recession and China's growth problems become more material than what we think now. In fact, we think China has really executed a soft landing, which is good not only for them, but for the world as a whole. So we appreciate your time and attention. Hope you have a great winter, and we'll look forward to catching up with you in the spring.